So I think over the past 6 months, and really since the positive news that we had around vaccines, what we've seen in high yield markets is that yields have fallen further as hopes for an end to the pandemic have grown. So when we are investing and then assessing a holding within the trust, we have to take a view on the credit and the credit risks. Um, if they change, or if the yield that's on offer changes, then we really need to start thinking about, is it appropriate? Is that level of yield appropriate for the level of credit risks? So what we have been doing over the past 6 months, I would say, is coming to that conclusion on more and more names within the trust. So selling positions, trimming positions, just being careful about the level of risk that or the level of yield that we're getting for the risks that we're taking. That also has included some profit taking, especially on bonds that were purchased back in March, April, May of last year. Some of those we've made very attractive capital gains on, but the downside to that is they've now started to offer relatively low yields. Another feature of the past 6 months in particular, since the start of this year, 2021, very strong appetite for high yield bonds has led to very strong what we call new issuance markets. So when new bonds are issued, those bonds are being issued with lower and lower coupons. So we're generally being more and more, well, we're always selective, but we're investing in typically less and less bonds as they're brought to the market. Often that's an issue on pricing, so on the coupon. But more often this year, what we are seeing, more often than we saw last year, is as the market has reopened, we're starting to see companies issuing bonds with balance sheets that are looking more stretched. So we're seeing more issuance like that this year, and we're being very selective with that. Performance more recently on the trust has been good. High yield markets generally have performed well this year. The riskiest parts of the market. So the trust's performance as at the end of May was 3.3% on an NAV basis. That's after fees. In terms of other changes within the portfolio, the team, obviously BIPS, Invesco Bond Income Plus, was formed through the merger of Invesco Enhanced Income and City Merchants High Yield, two trusts that we managed for many, many years. That happened in May of this year. IPE was traditionally run with a higher level of gearing than City Merchants High Yield. And so the aim here on BIPS is to start with a gearing level of around 10% of NAV. And that allows us to buy more of those bonds that we're comfortable with, using gearing, and then to help support the income level and the dividend target that we have. And that's especially important when yields are as low as they are in the high bond market. So that reflects a change in terms of the gearing levels that Invesco Enhanced Income or IPE shareholders were used to, and less of a change for City Merchants High Yield shareholders. The portfolio has become more diversified in terms of holdings. I think that's sensible when the market feels like it does offer less value like this. Sector-wise, we tend to be fairly stable. And again, it comes back as well to that bottom-up credit selection. At the start of the pandemic, we did reduce our holdings in some sectors that we felt would be more impacted by lockdown. So we owned less retail, less travel, less leisure. Then last year, and a little bit more this year in the last 6 months or so, we've added in small size really to some of those reopening names, airlines, airports, etc. But crucially from higher rated companies that have more robust balance sheets. That's very important for us when investing in those reopening names. We've also increased our exposure to banks. Not dramatically, but that has happened. I think we're relatively comfortable on the banking space, bank bonds. During the financial crisis, banks were the problem, but we see them this time as actually being part of the solution in getting funds out to businesses. So I would say, there have been some changes this year. It's been generally focusing on value and declining yields and selling. But we've also had one eye on inflation risks. So thinking about rate sensitivity within the portfolio. So reducing and selling positions to reduce that rate sensitivity, selling positions that are more exposed to rates rising, and then also being very careful about what we add to the portfolio. Ultimately, in terms of inflation, I think some inflation is good for high bond markets, as it usually implies economies are growing and companies are doing better. But too much inflation is when we start to worry. A couple of holdings to talk about, and they're quite different in terms of their characteristics. So the first would be Clarios. This is the world's largest maker of lead acid car batteries, the type that we all have in our cars. And we all know that when your car battery goes, it needs to be replaced. So that this company has some classic features that a bond investor does find appealing. And it's worth noting that those features are usually quite different to how an equity investor might view them. Because of what they sell, that stability of earnings, of cash flows, as a bond investor, we really like that. So we lend money to companies as bond investors, and they pay us interest. The most important thing for us is that they will be able to pay the coupon and repay us at the maturity. So being big, having a stable cash flows as Clarios does, certainly gives us a lot of comfort around that. It happens that Clarios is also private equity owned and has relatively high leverage as a result. So this company is paying 8.5% coupon on the first bonds that they issued. Second example, and this hopefully makes me sound a bit more interesting, is a company called Inspired Entertainment. They make gaming machines and software for gaming machines. So they had a bad year last year. People were stuck at home. Their customers were not buying new machines. It's a very different proposition to Clarios in a few ways. It's more of a growth story, but a growth story, an ambitious growth story, can be it can be a point of concern if you're a lender. It's fine to have growth ambitions, but as a lender, we feel that adds risks, and so the only way that we're compensated for those risks is through the coupon. This company also had a bad pandemic, so investors needed some convincing. But for investors like ourselves who did the work to get to know the company, we get rewarded with an attractive income stream. So yields in high bond markets are at very, very low, if not record low levels. That makes it more challenging to find bonds that are paying an appropriate level of yield for the credit risks of investing. As I say, it's not impossible, but it is harder for us. So good credit selection, whilst it's always important for us, it takes on more emphasis at times like this. So doing our credit analysis, understanding the credit risks of the bonds that we're investing in. And then, of course, another important topic to consider is inflation. So will the coordinated actions of central banks and governments, which we've never seen before on this scale, will that be enough to push developed economies into high inflation? And I think it would be very foolish to claim to have the answer either way, but this is a risk we're cognizant of in the portfolio, and it's definitely weighed on more interest rate sensitive parts of the bond market this year. So we're responding to that by keeping interest rate sensitivity generally low in the portfolio. But really for BIPS, it's a case of just sticking to the types of higher yielding bonds that the trust normally holds.